Welcome to the deep dive. We're here to cut through the noise on complex topics, give you what you need to know, maybe with a few surprises. Today, we're plunging into something really dynamic, this sort of hub war brewing over in Asia. It's this intense competition, right, between Hong Kong and Singapore. Who's going to be the top global crypto hub?
It's definitely a high-stakes battle. And right at the heart of it, there's a specific kind of digital asset that's really taking off: stablecoins. These aren't just niche things anymore. They're actually changing how money moves, digitally speaking. And both cities know how important they are.
Absolutely. So, okay, our mission for this deep dive, it's kind of threefold. First, we'll unpack stablecoins for you. What exactly are they and why have they become so pivotal? Then we'll get right into that rivalry between Hong Kong and Singapore, looking at how they're each trying to win the crypto crown. And finally, this is key, we'll focus on why regulating stablecoins isn't just some detail, but maybe the thing that decides who wins this race. So yeah, get ready to connect some dots. Okay, let's start right at the beginning. Stablecoins, we hear the term, maybe see it in headlines, but what are they fundamentally? And why should you care?
Right. So, simply put, stablecoins are basically cryptocurrencies, but they're designed specifically to keep a stable value. Unlike, say, Bitcoin or Ethereum, how their prices can go wild, stablecoins try to avoid that. They're pegged or tied to something else. Usually it's a traditional currency like the US dollar, that's the most common one. Or it could even be a commodity like gold. Think of them as like a digital version of cash but running on blockchain tech. The whole point is to ditch that crazy volatility you see elsewhere. That makes them actually usable for, everyday stuff, not just speculating.
Okay, so built for stability, got it. But beyond just being less jumpy in price, what's their real purpose? What job do they do in the crypto world?
Well, that stable value, plus the potential for fitting into regulations, that gives them a big advantage for actual use cases. It makes them really useful as a way to exchange value.
Yeah.
Especially for things like cross-border payments or sending money home remittances. Also for business to business, B2B transactions, and even big companies using them for their internal treasury stuff. The big draw. They're fast, they're cheap, and they work 24/7. Imagine sending money globally in, like seconds, for hardly any cost, middle of the night. That's what stablecoins offer.
And when we talk scale, this is where it gets kind of mind-blowing, isn't it? How much have they actually grown? What does that tell us about their real impact?
Oh, the growth has been, well, explosive is the word. Just a few years back, the total amount of stablecoins was maybe $2 billion. Today, it's over $200 billion.
200 million.
Yeah, and get this, to give you a sense of scale, stablecoins, or rather their issuers, have become some of the biggest holders of US Treasury securities. Like huge holders. For instance, Tether, one of the main ones, holds something like $116 billion in U.S. Treasuries. Circle, another big player, holds about $50 billion.
Wow. Okay, hold on. So you're saying these digital things, stable coins, are holding over, what, $160 billion in U.S. government debt. Does that mean they've kind of quietly become major players in the traditional financial system, like a sort of digital shadow bank? That's pretty surprising, isn't it?
That's exactly it. Yeah, this data really shows stablecoins aren't just some fringe thing anymore, not just a blockchain experiment. They're quickly becoming like core infrastructure for payments, for how companies manage their cash, their liquidity strategies, for banks, for fintechs. It's not really if they should use stablecoins anymore. It's more like, okay, how do we actually do this? They're this powerful bridge,
Yeah.
Between old finance and the digital future.
Okay, but given how central they're becoming, what are the big risks? What keeps users up at night when they think about trusting stablecoins? It can't all be positive.
No, you're right. There are definitely some big concerns. Users often talk about centralization risks, especially with those fiat-backed ones, because, their stability depends on real-world money, actual dollars sitting in bank accounts somewhere as collateral. So they're still tied to the old centralized banking system,
Right.
which means if that bank holding the cash has problems, or if the company issuing the stablecoin messes up managing those reserves, well, that stable part can disappear pretty fast. We actually saw this play out, didn't we, during the USDC depegging scare. That was tied directly to its, $3.3 billion exposure when Silicon Valley Bank collapsed.
Yeah, that was a stark reminder. So it's not just crypto risk, it's traditional finance risk bleeding over. What else worries people?
Well, beyond that, there are worries about transparency. Like, how credible are the companies running these things? And are the smart contracts, the code that runs them on the blockchain, are they secure? Could there be bugs or vulnerabilities? And then there's the regulatory angle. People worry about government crackdowns, how might that affect using stablecoins? And it's worth mentioning, some users might even see stablecoins as a way to maybe sidestep taxes on payments, which obviously makes regulators pay attention.
Okay, so with those risks definitely on the table, are users just like holding their breath and hoping for the best, or are they finding ways to manage this danger?
Oh, they're adapting, for sure. You see a few strategies. Some just accept the risk, the potential reward is worth it for them. But more often, people try risk diversification.
Right.
So maybe holding a few different types of stablecoins, spreading the risk. A lot of people prefer the fiat-backed ones for holding longer term. They seem safer. And then there's risk avoidance. Like if there's big trouble with the stablecoin's reserves or the company behind it, some people just pull out of crypto altogether for a while. It's this constant balancing act.
Right, makes sense. Okay, let's pivot now. Let's talk about these crypto hub wars in Asia. Hong Kong versus Singapore. Two heavyweights, right? Both want to be the top dog for digital assets. From what you're seeing, who's actually got the edge right now? Is there a clear leader?
It's it's really dynamic. Actually, according to one recent index, the Crypto-Friendly Cities Index for 2025, Hong Kong has apparently pulled ahead of Singapore.
Yeah.
Yeah, ranked second globally. The report pointed to Hong Kong's recent efforts, boosting market access, trying to get the regulations right, focusing on blockchain efficiency. That's why they've climbed up. It surprised some people, I think.
That is a shift. Okay, so what exactly has Hong Kong done? What's in their playbook to grab that top spot?
Well, Hong Kong's been pretty active in laying down a clear foundation. Back in 2023, they rolled out this big virtual asset licensing regime. Basically, crypto firms operating there need to get licensed, meet certain standards, and crucially, they can offer services even to retail investors, not just institutions. That was a big signal. But it's not just rules. They've put serious money behind it, too. Government money for R&D. There's like a HK $2 billion innovation and technology venture fund and another HK $5 billion strategic tech fund. Both are set up to co-invest in tech startups, local and international. Plus, they've got these pretty attractive tax breaks for R&D spending, like huge deductions. It's a real push to pull in talent and investment.
That does sound like a strong push from Hong Kong, a clear, we're open for crypto business sign, but let me play devil's advocate. Does pushing so hard so fast risk maybe creating complex rules that are tough for new companies, or maybe leaving gaps they'll need to fix later?
That's always a risk, yeah, when regulations are evolving quickly.
Yeah.
I think the hope in Hong Kong is that by being proactive, by setting out a clear framework early, they actually reduce uncertainty. Uncertainty is a killer for business, right? So they're trying to preempt that.
Fair enough. So how does Singapore stack up? They were seen as an early leader, weren't they? What's their strategy now?
Yeah, Singapore was definitely proactive early on. They attracted a lot of funding, something like $627 million for crypto firms in 88 deals just in 2023. Their central bank, the Monetary Authority of Singapore, MAS, they took this sort of forward-looking but also quite cautious stance. By January 2024, they had licensed about 19 crypto service providers. Their main law here is the Payment Services Act from 2019 that governs what they call digital payment token, or DPT providers, even though crypto isn't actually legal tender there. So yeah, they were definitely early movers.
Okay, and we've heard Singapore's approach called threading the needle. What does that actually feel like for a company wanting to set up there? Is it tricky?
Yeah, threading the needle really captures it. It's about MAS trying to balance two things: attracting innovative businesses, but also managing financial risks really carefully and protecting consumers. And just this year, in 2024, they tightened things up even more. MAS expanded that Payment Services Act with stricter rules for user protection and financial stability. It covers more activities now like crypto custody, running exchanges, cross-border transfers, and this means tougher licensing rules. You need like SGD 250,000 in minimum capital, really strong cybersecurity, thorough background checks. They've also got strict consumer protection rules, and they enforce the travel rule for crypto transfers.
The travel rule, remind me, that's the one about sharing sender and receiver info on transactions.
Exactly, yeah. Just like in traditional finance, passing on that data for certain transactions.
Okay, so Singapore's building this fortress of stability. It sounds great for established players, maybe, but what's the flip side? Could being so strict actually scare off the smaller, more nimble innovators?
That's exactly the worry you hear from some analysts, this idea of a potential brain drain. While MES's approach definitely bring structure, clarity, make sure firms are solid, some worry these really tough policies might push developers or entrepreneurs to look elsewhere. Places with maybe a softer touch, regulations that feel a bit more welcoming, even if less robust. So it could potentially slow down Singapore's role as the region's big innovation hub. It's that tricky balance again.
Right. So Hong Kong, new rules, big incentives, pushing hard.
Mhm.
Singapore, refining an already strong but maybe demanding framework. Okay, let's bring it back to stablecoins. How crucial are they in this whole competition? Is regulating them the key factor or just, one more thing on the list?
Oh, it's absolutely critical. That's a really important point. Stablecoins aren't just, another type of crypto asset. They are actively powering payments right now, today. And they're seen as this huge engine for market growth across Asia. So how these two hubs decide to regulate them, that could really shake things up. It could fundamentally change how money moves in the region. They're like the digital rails for future finance, you could say.
Digital rails, I like that. So if they're the rails, how is Hong Kong specifically laying down its tracks for stablecoins? How are they regulating them?
Well, interestingly, stablecoins weren't explicitly covered in Hong Kong's first big crypto licensing push. That was a bit of a gap. But that's changed now, fundamentally. Hong Kong just recently passed a specific stablecoin bill. It should come into effect later this year. The HKMA, that's their monetary authority, and the Treasury Bureau, they've proposed a whole new licensing regime just for issuers of stablecoins pegged to fiat currencies, like the HK dollar or US dollar. And the rules are strict, really strict conditions to get a license, especially around managing the reserves backing the stablecoin. For example, issuers have to prove the value of their reserve assets is always at least 100% of the stablecoins out there. Those assets have to be high quality, easy to sell, liquid, and crucially, kept totally separate from the issuer's own company funds. It's a very clear move to bring stablecoins fully into their regulated system, build maximum trust.
That sounds very deliberate from Hong Kong. Like, okay, we see the gap, we're filling it, and we're setting a high bar. So what about Singapore? They already regulate digital payment tokens, which includes stablecoins. Are they just sticking with that or refining their approach too?
Right. Singapore's MAS already includes stablecoins under its Payment Services Act umbrella. So companies dealing with stablecoins, custody, exchanges, transfers, they already fall under those strict licensing rules we talked about. And those updated guidelines from 2024, they definitely enhance consumer protection around DPTs, including stablecoins. But they also meet those significant requirements, like the SGD 250,000 capital, the cybersecurity rules. The challenge for Singapore, as some observers see it, is whether that very stringent approach, even though it's designed for safety, might inadvertently push some firms towards places perceived as having a, quote, softer, more welcoming stance, even if Singapore offers perhaps more long-term stability.
So it's really interesting. Both cities clearly get how vital stablecoins are, like foundational tech. But they seem to be taking slightly different philosophical routes on how tight the leash should be. Hong Kong's building this new dedicated stablecoin framework from the ground up, almost, while Singapore is kind of weaving it deeper into its existing, very comprehensive but maybe demanding structure.
Exactly right. The race isn't just about attracting cool new tech. It's about attracting it while making sure the financial system stays stable and consumers don't get hurt. For Hong Kong, it feels like they're saying we're adapting fast, adding stablecoins specifically to show we're serious and responsive. For Singapore, it's more about reinforcing their reputation for thoroughness, maybe tightening controls within their existing robust system. How stablecoins are regulated is just so central to adoption, to market growth, and how each city plays this regulatory card. That's definitely going to be a huge factor in deciding who really comes out on top as the main crypto hub in Asia. We're watching a real-time policy experiment unfold.
What an incredible deep dive. We've really unpacked stablecoins, seen how they've gone from this niche idea to being really core infrastructure, especially for payments, and how companies manage money.
And we've seen how Hong Kong and Singapore, these two huge financial centers, are really thinking strategically about regulation, especially stablecoin rules, as they battle it out for that crypto leadership spot. It just underscores how critical regulatory clarity and, robustness really are if you want to attract these digital asset businesses.
Yeah, the competition is definitely fierce. It'll be fascinating to watch how their different approaches play out. Will stricter rules build more trust in the long run? Or will they inadvertently push innovation somewhere else, maybe making the global crypto world even more fragmented? This story, this hub war, it's definitely not over yet. Thanks for diving deep with us today.